What's going on, traders? Welcome back to Explain the Charts. Today is November 12th, 2025, and we are doing an in-depth analysis of EURUSD, which is sitting at a fascinating crossroads. The market is currently caught in a tug-of-war between several powerful narratives. On one hand, we have growing expectations of a Federal Reserve rate cut, and on the other, we have the imminent resolution of the long-running U.S. government shutdown. First, we'll break down the news and the macroeconomic picture, and then we'll dive deep into the charts to see what the technicals are telling us. Fundamentally, the biggest story is the divergence in monetary policy. Recent weak U.S. employment figures, specifically the ADP report showing consistent job losses, have pushed the probability of a Fed rate cut in December to over 60%. This, combined with retreating Treasury yields, is creating a significant headwind for the U.S. dollar. Countering this weakness is the news that a deal to end the government shutdown is almost complete. While this removes a layer of political uncertainty and could give the dollar a temporary lift, the underlying economic data remains a concern for dollar bulls. Meanwhile, in Europe, the ECB is standing firm. President Christine Lagarde has made it clear that rate cuts are not on the near-term agenda, which provides a baseline of stability and relative strength for the euro. Eurozone data has been mixed, with German investor confidence dipping, but overall Eurozone sentiment has improved. This sets the stage for a classic battle between a potentially weakening dollar and a stable, albeit stagnant, euro. Now, let's turn to the charts and look at the big picture on the daily time frame. We can see a strong uptrend through the first 3 quarters of 2025, which peaked here in mid-September, just above the 1.1900 level. Since that peak, the trend has clearly reversed. We've been in a bearish structure, making a distinct series of lower highs and lower lows. However, last week the price came down to test the crucial psychological support level around 1.1500, with the actual low being just below it at 1.1470. This level held firm, and we've seen a significant bounce from those lows over the past few days. This brings us to the most important level on the chart right now, the resistance zone between 1.1590 and 1.1610. Breaking through this area is the primary objective for bulls, while bears will be looking to defend it aggressively to maintain the downtrend. Let's zoom into the 15-minute chart to see how this recent bounce has played out. Here we can see the price action starting from November 10th. The market consolidated and began a steady grind higher throughout Monday's session. Then, on Tuesday, November 11th, we saw a surge of bullish momentum. Price broke cleanly through the 1.1580 resistance area and pushed all the way up to test the 1.1600 handle before pulling back slightly. Crucially, the pair closed very strong near the session highs, which suggests buyers were in control heading into today's trading. To understand why that 1.1600 area is so critical, I want to show you this price action on the 1-hour chart from late October. As you can see, this zone acted as a major battleground. Price chopped back and forth, finding both support and resistance right where we are trading now. This creates market memory, meaning a lot of traders will be watching this level to make their next move. This is the very definition of a decision point for the market. A firm break and hold above this zone could invalidate the recent bearish structure and open the door for a much larger move higher. Conversely, a strong rejection here could confirm that the downtrend is still intact, and this was merely a corrective bounce. So let's bring it all together and recap the key levels to watch. The line in the sand is the resistance zone from 1.1590 to 1.1615. For the bulls, a decisive daily close above 1.1615 is needed to confirm a breakout. If they achieve that, the next targets are the recent lower high at 1.1668, followed by the psychological level of 1.1700, and then the key Fibonacci level at 1.1748. On the downside, immediate support lies in the 1.1530 to 1.1540 area. A break below this would be a warning sign for buyers. The critical support, however, remains the 1.1500 handle and the recent low of 1.1470. A failure to hold this zone would signal a clear continuation of the medium-term downtrend, with targets at 1.1460 and possibly even 1.1400. Now for some unbiased predictions. Given the building fundamental case against the dollar with Fed rate cut expectations, I'd place a slightly higher probability, around 60%, on a bullish breakout scenario. The short-term momentum is with the buyers. A daily close above 1.1620 would strongly reinforce this outlook. However, there is a very real 40% chance that this is a bull trap within a larger downtrend. We must respect the bearish structure on the daily chart. If we start seeing strong selling pressure and rejection at the 1.1600 level, this bearish scenario becomes much more likely. A breakback below 1.1530 would be the first confirmation for sellers. To summarize, everything hinges on the market's reaction to this 1.1600 zone. Keep an eye on upcoming comments from Fed officials and any new data that emerges as the government shutdown backlog clears. And as always, please remember that this is for informational purposes only and is not financial advice. Trading involves risk, and you should always do your own research before making any investment decisions. Thanks for watching Explain the Charts. If you found this analysis helpful, please hit that like button, subscribe, and ring the notification bell so you don't miss our next video. Trade safe, and I'll see you in the next one.